Thank you, everyone who's come to join us for this event today. My name is Joe Billsborough. I'm a research assistant at HEDG, which is the Historical Economics and Development Group at the University of Southern Denmark. We're joined today by my colleague, Professor Paul Sharp. Paul will be doing the moderating in today's event, and a sort of technical, logistical request. If you could please post your questions in the Q&A, it makes it much easier for us to keep track of them. But the sort of main event today, we're incredibly lucky to be joined by Professor John Turner. He's a professor of finance and financial history at Queen's University, Belfast. He's editor of the Economic History Review, and of particular relevance for today, the focus of today's talk will be his co-authored book, Boom and Bust, A Global History of Financial Bubbles. I'm looking very much forward to hearing about this. So John, the floor is yours.
Thank you very much, Joe and Paul, for the invitation to come and speak today. I'm going to share my screen at this stage. And just, Joe, can you let me know that you can see that okay?
Yeah, we can see that.
Okay, cool. Okay, thank you. Okay, well, welcome everyone. It's a sunny day here in Belfast. It's probably where you are too, hopefully a sunny day. And what I want to talk about briefly this afternoon is my book, co-authored with my colleague, William Quinn, Boom and Bust, A Global History of Financial Bubbles. And that's what it looks like for those of you who are interested. It's available in all formats. Audio, digital, and paperback and hardback. So want to really just give you an overview of this book, okay, of Boom and Bust this afternoon. And 5 things I want to discuss with you. Okay, first of all, what is a financial bubble? And we're going to see that there's a little bit of controversy surrounding this issue. Secondly, what causes financial bubbles? Okay, so why do they happen? I then want to give you 2 examples of bubbles, and these we might call them lesser spotted bubbles. So these are 2 bubbles that are less well known that we document in the book, and that illustrate the causal mechanism that we talk about. I then want to think about the consequences of bubbles. Okay, so what happens after the bubble bursts? What's the impact on society and on the economy? And finally, then I want to bring this right up to date, because this book was published in August 2020. And of course, the question that everyone asks is, are we in the middle of a bubble? So in the middle of the pandemic, this strange couple of years we've had, was there a bubble in the midst of the pandemic? So that's where we're going. So first of all, what is a financial bubble? Well, let's look a little bit at the etymology of this word bubble, or this metaphor, if you like. The first time that we have it used, we think, in the English language is in Shakespeare's play As You Like It, his famous All the World's a Stage speech in that play. And he uses the word bubble as an adjective, as something that's fragile, empty, worthless, just like a soap bubble. Okay? And then over the next 100 years, during the 17th century, the word bubble becomes a verb in the English language. And it means then, it's got this idea of deceiving. Okay, so to bubble someone was to deceive them. And so by the time the satirists like Daniel Defoe and Jonathan Swift were writing in 1719 and into 1720, they were witnessing all of these new companies being incorporated in London. And for them, these new companies were worthless, but also deceptive. And so they applied the word bubble to these companies. And this, of course, led to a very famous piece of legislation in the UK, the Bubble Act, which was a way of curtailing these bubble companies, so-called, being established. And so the bubble metaphor, if you like, stuck. And over the last 300 years, we still use it, but it's become a bit less pejorative. It's got less of a sense of deceiving and more of a sense of something that's fragile, empty, and worthless. So what then is a financial bubble? Well, this is actually a very contentious question for economists. So you have people like Eugene Fama, the Nobel Prize winner, and the word bubble, and this is a quote, it drives me nuts. And for Fama, the word bubble is devoid of meaning. We use it very casually, is really the claim that he makes. And there's a certain amount of truth in that. Then Peter Garber, in his book looking at the sort of first financial bubbles, he defines a bubble as a disconnect from fundamental values. So when you've got a share price and the share price doesn't reflect the underlying fundamentals, whether those be the future cash flows of the firm or the discount rate which we apply to those future cash flows, then you have a bubble. Okay, so there's a disconnect between the price of the asset and its underlying fundamental value. Kindleberger, and Kindleberger, we really admire and build on what Kindleberger did in his famous book on panics and manias. He defines a bubble as an upward price movement over an extended range that then implodes. And so what some economists have been doing, and we're included in this over the past number of years, is trying to parameterize Kindleberger. So what do we mean by an extended range? Well, several years. What do we mean? What's an upward price movement? Well, for us in our book, it's 100% plus, and followed by an implosion. And for us, that's 50%. And so our definition of a bubble is essentially we follow Kindleberger, but we parameterize it in that fashion. And so you can get some idea of what this looks like graphically. So here's an index of US house prices. So this is the Case-Shiller index going back to 1890. And you can see from this chart, you know, really house prices don't do very much from 1890 through to the late 1990s. But then all of a sudden we get this huge increase in asset prices, in house prices. And indeed, when you dig down into the US market and you look at, you know, the US market's divided into terciles, you look at the bottom tercile of houses, this is where a lot of the action was happening. And a lot of the action then was also happening in major metropolitan areas. But this is the overall index for the country. So you see this bubble-like pattern. We also have something similar happening in Japan. So we have a whole chapter in Japan in the book, but here's the bubble in land price, in land in Japan that takes place. You can see here, you know, really kicking off in the late 1980s, you know, land prices treble and then they collapse, you know, from 1990 onwards. And so this again is like a bubble-like pattern. So an increase in the asset of over 100% and then a decrease of over 50% in the asset price. And so that's how we define a bubble. Okay, so having that definition, what we did then is go and think about, okay, well, when did these major bubbles occur? And this is the list of bubbles here that we document in the book. We have a chapter on most of these bubbles in the book. Some of them you'll be very familiar with. So the Mississippi and South Sea bubbles are, you know, certainly very famous. The British real mania is quite famous, the dot-com, the subprime bubble, but lesser known bubbles then are also in here, such as, and we'll talk about some of those as well, such as the emerging markets bubble in 1825, the Australian land boom, you know, bubbles have been happening in China recently, and also this phenomenon called the British bicycle mania. Okay, so that's what a financial bubble is. Okay, so what causes bubbles? Why do they happen? Again, there's a lot of disagreement in or between economists on this point. So again, Fama, bubbles don't exist. Okay, now Fama said that in 1990, and I think the non-existence of bubble is a lot less plausible today than it was in 1990, because since then the Japanese bubble popped, the dot-com happened, the subprime. There's been several bubbles in China. We've possibly been living through a bubble, so I don't think that's plausible anymore. Minsky is interesting because he was resurrected, or his views were resurrected during the aftermath of the global financial crisis. And it's this idea that inbuilt into capitalist societies, there's this you know, cyclical nature of things. So you get bubbles, and then you get bank collapses and financial crises, and then in a short period of time you get another bubble, and so on and so forth. And so the idea is bubbles are cyclical. Okay, it's just an inbuilt feature of capitalism, but that's not what we're finding when we look at 300 years of history, because we find this huge temporal variation in the frequency of bubbles. Occasionally there's been 100 years between bubbles, and other times, more recent times, it's been 5 or 6 years between major bubbles. And then there's the famous view of Nobel Prize winner Robert Shiller. Bubbles are caused by human irrationality. We've got all of these psychological biases that drive our behaviors. However, for us, this is a rather incomplete explanation. Why do you get bubbles sometimes in some assets, but not others? And so we almost sidestep the issue of irrationality. We don't think it's necessary to help understand why we have bubbles. Instead, what we do in the book is we develop a framework to think about bubbles and why they happen. We actually think the bubble metaphor, it was the wrong metaphor. A better metaphor might have been fire. Okay. And that's the metaphor that we use in the book and develop in the book. And you may remember your high school chemistry. You need three things, three necessary conditions for a fire. You need heat, you need oxygen, you need fuel, and then you need the spark to generate the heat, and then the chemical reaction kicks off. And we think bubbles are something similar. There's a bubble triangle. So let me explain to you what the three sides of the bubble triangle are. First of all, we've got the fuel. So we've got the money and the credit. So in times of low interest rates, for example, investors reach for yield. And this is a well-known phenomenon. So Walter Bagehot, who was an editor of The Economist back in the 19th century, a polymath in many senses, he said that John Bull can withstand many things, but he can't withstand 2%. Now, John Bull was the stereotypical Englishman, if you like, the representation of stereotypical Englishman. And Bagehot's saying that when interest rates are 2%, John Bull's going to reach for yield. John Bull's going to invest in riskier assets. But also with fuel, you've got a credit. Okay, so banks or other institutions lending to investors who are then buying the bubbly asset, whether that be houses, whether that be stocks, whether that be land. Okay, so you also have the credits. That's the fuel side. Then you have the oxygen side of the bubble triangle, or the marketability. So the ease with which an asset can be bought and sold. And one of the sort of themes in what the narrative arc, in a sense, in Boom and Bust, is the increase in marketability over the past 300 years. And this increase in marketability comes from legal changes, comes from deregulation. It also comes from technology. Okay, and what we observe during bubbles is that there are improvements in marketability, which then help which then help drive the bubble. And then the third side of the bubble triangle is the speculations. I know speculators always exist in financial markets, but during bubbles, what tends to happen is that novice speculators or amateur speculators are brought into the bubble, and they become almost like momentum investors, and they help drive up prices. And again, this is something we observe across these historical bubbles that we look at. Now, you may say, well, of course, if you've got all of these amateurs piling into the market, why don't the professionals then go short and you won't have a bubble emerging? Well, again, what we observe across the historical bubbles that we look at is there are constraints on short selling. There are constraints on the ability of professionals to bet against the rise in prices. And I'll maybe say a little bit more about that when we get into some of the details. So three sides, three necessary conditions: marketability, money, credit, speculation. But it needs a spark. Okay, the speculators, if you like, need a spark to kick this whole process off. And the spark for us either comes from politics. Okay, so there's regulation, there's new changes, the politicians are driving an agenda, and that sparks the bubble. So a lot of the bubbles in our book are politically driven, or it's some radical new technology that speculators get excited about and possibly overexcited about. And so these are the two main sparks that spark off the bubbles in our book that we look at. So what I want to do now is delve into the history a little bit and talk about two examples of bubbles. I want to talk about a bubble, first of all, that's sparked by a radical new technology. And then I want to talk about a bubble that's sparked by government policy and by politicians. And these are bubbles that most of you will probably not have heard about before. First bubble that I want to talk about is the British bicycle mania. In the late 1880s and into the 1890s, you get the confluence of certain innovations that give us the modern bicycle. So on the left here of your screen, you'll see what was known as the penny farthing, named after the two coins, so the large farthing and the small penny. And well, let me put it this way, for those of you who like to cycle, I don't think you'll be wanting to do the Tour de France in this bicycle. But within a matter of years, this bicycle was replaced by the bicycle on the right, which looks very much like the bicycles that we use today. And so major technological advances have taken place: ball bearings, well-less tubes, pneumatic tires, to name three things that came together to build the modern bicycle. And so there's a lot of excitement about this new technology. A lot of this new technology is being developed in and around Birmingham. So the UK's, some Scottish people might disagree with it, but the UK's second city. And all of these companies then are establishing basically to help build bicycles. And so what I show in this, this table are the number of cycle incorporations. So these are companies incorporating and issuing some sort of securities on public markets. And you can see that in this 2.5-year period, from 1895 through the middle of 1897, we have 671 cycle companies on the UK, incorporated, and some sort of security being traded in the UK market. And you can see that in terms of the nominal capital, this is a huge part of the market at the time. So you get all of these new companies establishing. Alongside that, you get a ramping up of bicycle share prices. So what we have in this chart, the sort of dotted line, is the general stock market index, so like a blue chip index. It actually does vary quite a bit. It just looks flat because the scale of the bicycle appreciation was so great. Here we've then got an index of cycle shares, and you can see during 1896, from late 1895 through 1896, this huge increase in the prices of cycle shares, almost trebles, and then you get a collapse taking place in sort of 1897 into 1898, and the demise of these cycle companies. You see the index falls far below where it started off in 1890. So we have this classic bubble-like pattern. So the question is, why did it happen? Okay, why did it happen? Well, let's apply the bubble triangle framework to this. So in terms of money and credit, the fuel, well, we've got record low interest rates. So in 1896, UK interest rates are at their lowest point ever. They literally are at the 2% that Walter Bagehot was talking about. And so you get this reaching for yield. And so you see investors, moving towards riskier and riskier assets. One of those is these new technology companies, cycle companies. There's also other things happening in the UK stock market this time. So a lot of brewery shares coming to market. So there also is a boom in brewery shares, driven by these record low interest rates. In terms of marketability, there's been a few innovations in the stock market. First of all, the innovation of small denomination shares. So the £1 shares is popularized in the 1890s. Okay, so this now opens up the market it democratizes the market and brings in whole swathes of lower middle class and working class investors into the market. And marketability is also improved by the fact that you've got these long established private companies coming to the market and making their shares available. And so you get this sudden burst of marketability, liquidity in this conversion of private companies into public companies. And you also have rampant speculation. So as well as the denomination falling to £1, okay, makes shares more marketable, but it also allows speculators from wider social classes to come in. And so you get a lot of that happening. You also have a lot of what's known as stag investing. So these are people who are subscribing for cycle shares in the hope that on the first day they'll be able to cash out and earn a really good return. You also have major corners in cycle shares, which actually prevents cycle shares being shorted and the bubble in shares being corrected. Okay, so you have an inability to speculate against the bubble. And of course, then it's this new technology that was really sparked up. People got really excited about these bicycles and how they were going to transform things. And indeed, to give you some idea, the sales of bicycles in the 1896 and 1897, I think it was 1 million bicycles were sold in the UK alone. So that gives you some idea of the sort of the change that this new technology brought about. We can also think of some other episodes that we cover in the book being driven by new technology. Okay, so you can think of the Wall Street boom of the 1920s, followed by the Wall Street crash, as being driven by new technology. You've got the electrification of factories, which is the big technological change. So all of a sudden, you're moving from steam power, from human power, from whatever, and you're moving into electrification of factories. You also have the development of automobiles, radios, and other radical new technologies which help transform society. And this is, we think, part of the story behind this. It's also, of course, part of the story behind the dot-com. So here we have the S&P 500 during the sort of 1990s into 2000, and here's the NASDAQ, which was the new technology index, or the index for internet stocks and telecommunication stocks. And you see that again, this bubble-like increase in these internet company .com prices, and then followed by a collapse. Again, this radical new technology that investors get excited about at a time of low interest rates, etc., etc. Okay, so the second bubble that I want to talk about, and one that I had a lot of fun. I did most of the underlying research for this because I went to Australia to do this, and this is the Australian land boom that took place in the 1880s. To give you some idea of the scale of this land boom, in the 1880s in Melbourne, the annual return on suburban land as an asset class was 40% per annum. Okay, so if you were an investor, a speculator in suburban land, that's the sort of return that you were generating. And if we look at sort of land prices, the average suburban land prices in Melbourne, okay, so Melbourne suburbs are being built at this time. They started in 1882 at £39 per square foot. By 1888, the peak of this land boom was at £300 per square foot. It had collapsed to 1890 down to £154 per square foot. So you get some idea of the scale of this land boom. And in the big boom year, which was 1888, so between January and October, land prices in the central business district almost trebled within Melbourne. And you also get the emergence of these sorts of buildings here. So here's the famous Sphinx building in Melbourne. The structural engineering at the time was only developed so that 12, 13 stories was about as high as most skyscrapers could go to in the 1880s. And Melbourne was on a par competing with the likes of New York, London for high-rise buildings at this time. It gives you again some idea of the scale of this boom. There's also a boom in the stock market at this time. And one of the principal sets of companies driving this boom were what were known as the land boom companies. And so these land boom companies were 1/3 property developer, 1/3 property speculator, 1/3 bank. Really bad combination, as it turns out. And so again, what I went to Melbourne to do was to basically gather the share prices of these various land boom companies. This is a weighted index, so it actually doesn't really give you the full picture of what was going on. So these land boom companies, which are set up in the 1887, they double in price by June 1888, and then they collapse through to June 89. In fact, if we were to continue this on, and I couldn't continue it on because they stopped being traded and there's no observable prices, and most of these companies disappeared, this actually would go down close to zero again. And this, of course, then feeds through into house prices. So here's house prices in Melbourne. So the price of land is going up tremendously in the 1880s. And so therefore the price of houses is also going up. And it nearly doubles in the typical house, nearly doubles. And then you get this huge fall off in the price of houses. And, in 1900, 12 years after the boom has collapsed, house prices are just about where they were in the early 1870s. To get some idea of the scale of this land boom. So again, what was going on in Australia, and particularly in the cities of Melbourne and Sydney? Well, first of all, you had low interest rates. Okay, you had the policy rate being driven down by the authorities. Okay, so that's one thing. You also had easy credit. And so you get the emergence of a banking system which is unregulated, and I'll be saying a little bit more about this later on. It's essentially unregulated, and you then have these shadow bank type institutions emerging. So these land boom companies, again, so much credit flowing around, and then money flowing in from the UK as well. So there's fuel, there's plenty of fuel. In terms of marketability, we have in this era the development of the quarter-acre plot, which is a kind of a standard size of a suburban plot in Australia. So if you think of all these Scottish and English and Irish people that emigrated out to Australia, they had come from these really, horrible, dark, smog-filled cities, and they really dreamed about having their suburban house. And so these quarter-acre plots were like gold dust. And so standardization that you get with that. You have multiple stock exchanges appearing in Australian cities. So in 1888, there were 6 stock exchanges allegedly, transacting shares and other instruments in Melbourne. You also have speculation, and so again, you get all of these amateurs moving into speculation in land, in property, and in shares. And so what's then the spark that sets off this boom? Well, the spark that sets it off is the fact that the politicians in the various colonies, so whether that be Victoria, New South Wales, many of them were real estate speculators, developers. Many of them had connections to the real estate industry. They were directors of these land boom companies. And so they were moving in Parliament to make things easier for these companies to be established. They also, and this is critical, they also deregulated the banking system in 1887 so that it could lend on the security of a mortgage on land. And up until that point, that hadn't been legally possible. I think banks were, nevertheless, there's evidence to suggest that they were doing it. And so it's politicians, and for their own ends and for their own greed, if you like, that are really driving this land boom. Just to give you some idea then of the vulnerability of the Australian banking system. So there's 28 banks in Australia at this time, and they grow really vulnerable during this land boom. So in terms of sourcing deposits from overseas, largely from the UK, so these Australian banks would advertise for deposits in Scottish and English newspapers. And so by the time we get to sort of the late 1880s and into 1890, a quarter of their deposits are coming from overseas. They're becoming a lot more levered. Okay, so there's got less capital relative to their deposits over time, and that becomes worrying. They rapidly expand their branch network because what they're trying to do is hoover up all the deposits around Australia. And the branch network essentially doubles in the 1880s in the push to hoover up these deposits to feed through into the land development companies. Okay, so that's just 2 examples of bubbles that we cover in the book. And I want to think about the consequences, very briefly about the consequences of bubbles. Okay, what are the consequences for society? What are consequences for the economy? So let's think about the 2 bubbles that we've discussed so far. The bicycle mania, okay? And we actually think the bicycle mania was an example of what we call a useful bubble. So again, it goes back to the fire metaphor. Some fires are good for the ecosystem. So you get some ecosystems and they're reinvigorated by fire. Fire is a very important part of the reinvigoration of the ecosystem. And so it is with bubbles. Some bubbles are actually useful. So the bicycle mania wasn't followed by a financial crisis. It wasn't followed by a drop in GDP. There is some evidence that in and around Birmingham, the collapse or the popping of this bubble did have a small role to play in sort of the local economic growth. But on the whole, there were good things came out of this bubble. First of all, there's women's liberation. Prior to the bicycle, it was really difficult for women to move about a city safely and cheaply. The bicycle liberated women, and so all of a sudden they can now move about cities. And indeed, when you look at the suffragette movement that emerges, there's lots of them of pictures of suffragette movement with bicycles. It also sort of stimulated the whole fashion industry around women's clothing and their ability to ride bicycles. There's also then the technology that's developed by these innovative bicycle manufacturers, because all of a sudden they've manufactured all of these bicycles, and there's competition now in the market, in the product market. So what are they going to do with all this technology that's developed? And so some of the more astute bicycle manufacturers end up becoming motorcycle manufacturers. Some of them end up becoming automobile or car manufacturers. Some of them end up becoming plane manufacturers. A little known fact, the Wright brothers started off as bicycle manufacturers. And so the bicycle mania we think was useful. An example of a bubble that wasn't useful was the Australian land boom. So the Australian land boom collapsed tail end of 1888, but the economy, they managed to keep the plates spinning within the financial system for another 2 to 3 years. But it all went sour in late 92, early 93. And one half, so 14 of the 28 Australian banks collapse. That's over half of the asset base of the Australian banking system. There's then emergency procedures set in place, and they try and reinvigorate the banking system. So in my book, as someone who's looked at banking crises globally, this is like one of the largest banking crises that any country has ever experienced. And when you look at how this then affected the Australian economy, okay, so what we do in this chart is we compare the depression of the 1890s in Australia to the Great Depression of the 1930s. So the red line's the Great Depression, the 1890s is this blue line. And you can see here that the depression in the 1890s after this land boom was deeper and was longer in Australia than the Great Depression. Indeed, in some parts of Australia, it's reckoned it was like just before World War I that the economy actually had got back to where it had been sort of in 1891. So there's an example of a catastrophic bubble, destructive bubble. So one of the things we do in the book then is try and figure out, well, what makes some bubbles useful and what makes some bubbles destructive. And so the way we do this in the book is we have this 3x2 grid. And so here we have the sparks, whether it's caused by politics or whether it's caused by technology. Here we've got the type of leverage that was used as the fuel. So here we've got bank leverage, okay, and that's the super fuel of bubbles. We've got high capital market leverage, which is where there's margin lending, so that people can buy shares, or in some of the earlier bubbles, there was almost like a deposit system that you could pay a small deposit to buy a share, and then you could face further calls down the line. So again, that's a type of leverage. Or you can have low capital market leverage where people aren't really borrowing to buy these shares. And so what we find is that when you combine a political spark with high bank leverage, these bubbles were all catastrophic. They all had detrimental consequences for their economies. Many of us lived through the subprime bubble. We can testify to that. The Japanese bubble, I remember as a student in the late 80s, the early 90s, everyone was talking about the Japanese model, and then all of a sudden the crash happens. And then, in the 10th anniversary of the crash, it's the lost decade. Then in the 20th anniversary of the crash, it's the 20 lost years. Australian land boom we've already talked about. And then the Mississippi bubble and the long-term consequences of France of the Mississippi bubble in terms of the development of its financial system. And, there's some historians would even say their ability to fight wars was hampered by that bubble. And then the useful bubbles are down in this sector where you've got a technological spark and low capital market leverage. So think dot-com bubble, think bicycle mania. Finally, what about the last couple of years? Again, this is the, if I had a Bitcoin for every time I was asked this question, I would have a lot of money, a lot less money than I would have had several months ago, but I would have a lot of money. So have we been in a bubble during the pandemic? So what I've done in this chart is document from the 1st of January 2020 to the end of 2021, so the 2 years of the pandemic, the increase in prices of some major cryptocurrencies. And so we've got these meme cryptocurrencies, or if you like, they're almost joke cryptocurrencies like Dogecoin and SHIB up top, and then things like Bitcoin. And you can see here the huge increase in the prices of these assets. Bitcoin's at 800%, Ethereum's up at 2000+% in this period of time. this huge increase in the prices of these assets. But this is all peaked out. So end of October, start of November, things have started to go well before Ukraine. In fact, Ukraine actually helped breathe a bit of life into some of the cryptocurrencies. But since, as I say, since the peak, which was end of October, start of November 2021, you look at Bitcoin, it's down. I checked the prices this morning, they're down 39%. You look at Shiba Inu, it's down 70%. You look at Dogecoin, it's down 80% since the peak back in the start of November 2021. And then there have been other bubbly assets, green technology stocks. And so there's been a lot of increases in prices of green technology stocks. And again, there's a bit of a reset coming. Again, the Ukraine war has given them a bit of a fillip. And then tech stocks. And so everyone was looking at Tesla, but other tech stocks as well. And again, ramped up in price and beginning to collapse. So Netflix more than doubled in price during the pandemic. But since the start of November, it's lost 70% of its value. And so we think that there may be something happening here. And again, we apply the bubble triangle. Again, Will and I are only beginning to think about this in terms of what we think about it, but very low interest rates. Okay, the pandemic, of course, pushed interest rates even lower. We now have something that kind of really unheard of, sort of widespread margin trading for amateur retail investors across the board. You have increase in marketability with online apps, which basically allow you to trade commission-free, things like Robinhood, Coinbase for the cryptocurrency. So again, this technological innovation is taking place. And then the speculation, well, you've got bored millennials during lockdown. Okay, so sports have been cancelled, you couldn't bet on things, and people all of a sudden have got extra cash. And so they begin to speculate in cryptocurrencies and some of these tech stocks. Now, the question for us is what's really sparking this, and we don't have a clear handle on this yet. So for sure, it could be the technology associated with green technology, particularly with crypto, or it could be something to do with politics here. Again, the suppression of interest rates at super low levels, the injections of quantitative easing, but also the whole crypto sort of universe has emerged out of an anti-establishment sort of background. So the whole background to Bitcoin is it's anti-government, it's libertarian. And so again, there could be political things helping to drive all of this. So I've taken up enough of your time. I hope you've enjoyed what I've had to say. And I think, Paul, we maybe have some questions at this point. If I stop sharing my screen.
Thanks so much, John. That was really, really fascinating. Yes, I do have some questions, but before we get to any of my questions, I want to say to everyone listening at home, you cannot kind of ask your question live. You need to write your question in the Q&A. So there's a Q&A section at the bottom of your Zoom window, and just write your question in there, because then I can administer it. Don't write it in the chat part, so only in the Q&A part. And then once you've written your question, I'll read it up and then John can answer. Okay, so while we're waiting for people to write questions, so I really like this this analogy with the fire and so on. It got me thinking about one thing in particular, which is, I mean, somehow you can imagine that you can't have a bubble unless you have some sort of basic level of development, right? And so I suppose it's not completely coincidental that I suppose one of the most famous bubbles started in the Netherlands with the tulips and so on, that we all know about, right? If that was a real bubble, I don't know. But what does this mean? Does this mean that as societies get kind of richer, that we could expect the frequency of the bubbles to increase more and more? You mentioned very briefly about sometimes they can be 100 years, sometimes 10 years, right? But is it something that we could expect that as more countries develop, we'll get more and more bubbles? Or is this is it at a certain point of development, then you just get to a situation where you can have bubbles and that's it?
Yeah, thanks, Paul. So yeah, the whole issue of tulips. So again, at the start of the book, we spent a lot of time, and we talked to the Dutch historians on this about tulips. So it's really interesting to think about how there's almost a myth around the tulip mania, and how we actually get that myth. And this is a really nice book by Anne Goldgar, and by a few other economic historians who have worked on this issue as well, which look at, there were satirical pieces written being very critical of the new middle class in Amsterdam and in the Netherlands that were spending their money in ostentatious ways. So like, for example, paying a lot of money for tulip bulbs. And so there was a couple of satirical pieces written about this sort of critical of this affluence. And these satirical pieces then are come into the English language through a guy called Charles Mackay. And so he's got this really famous book called The Madness of Crowds that's still in print today. And this is where we get this idea of the tulip mania. And it's a myth. It's based on satire. And indeed, throughout the piece, writing the book, we were able to pick up times when satire was picked up and was then portrayed as being the truth. And so the tulip bulb mania wasn't real, like it wasn't a mania. So what's the connection then to the second part of your question between sort of economic development and bubbles? Well, we think it's all to do with having a market. So a marketplace, a financial marketplace in particular, but also a marketplace for land and for commodities like land. And so it's when you get the development of these marketplaces, which then are typically associated with economic development, that you get these bubbles. But does increased development mean a greater likelihood of bubbles? Well, we actually don't necessarily think that that's the case. What actually we put across in the book is marketability is one of the key drivers of the increased frequency of bubbles and why we have them a lot more often. And this increased marketability is not necessarily connected to development per se. It's this neoliberal belief that, if something's liquid, that's better, and hyper liquidity is good for markets, and that's really the detrimental thing. So it's not economic development per se. It's possibly finance becoming far too developed. There's too much finance, and so again, there is evidence which suggests that that can be bad for development and for economies. You can have too much finance, and I think that's why we're seeing the greater frequency of bubbles. There's too much finance.
Makes a lot of sense. Okay, we have some questions now, so I'm going to kind of butt out a bit and read them up. So first question is from Karol Borowiecki. He says, "Many thanks, John, for one of the most fascinating hedge host talks so far." Fire exclamation mark. So there you go. By considering the history of bubbles, are there any long trends in terms of speed or intensity of bubbles bursting? For example, does better access to information affect the speed or extent of how bubbles form and burst?
Okay, that's a really interesting question there, because again, you do observe this across the historical bubbles. I don't know that there's a trend that I've spotted, but some bubbles, the speed at which the bubble implodes is a lot faster than others. So you take, for example, the 1929 Wall Street crash. You basically have a lot of margin lending helping to drive and fuel that bubble. And then when the margin loans are called, that sort of then there's a snowball effect. We see that type of thing also happening in China in 2015. A lot of margin loans are called in, and that really then pushes prices down at really rapidly. So I think when you've got margin lending, yes, you do see that, but that's not the case across all bubbles. Yeah, in terms of the information piece, yeah, so we actually spend a lot of time thinking about where investors get their information, and particularly the role of the financial press. And the financial press sometimes plays a wonderful role. It sort of is very critical of asset prices going up. It calls bubbles at various points in time. But there's other times when the financial press is actually they're bought into the whole bubble process, and they've got skin in the game, if you like, when it comes to that. So you can't actually trust the information they have. And so, yeah, that's something that we do cover in the book. And the question is whether you can trust your information sources and the incentives that your information sources have.
Next question is from Simon Bill. was not the Australian land boom a rural as well as urban story? There was massive westward expansion in New South Wales into low rainfall areas based on cheap money. The 1890s story is, of course, about drought, which contributed to the collapse in the rural land market.
Yeah. So Simon's going to be more of an expert on this than I am, but he is right. So one of the things that one of the reasons the land boom didn't fully implode to start with is that there was a really good sort of pastoral prices, agriculture was doing well, and then 1890s, you get the combination of, well, agriculture is not helping keeping the plates spinning anymore, and then the problems within the financial system are exposed. So there is that pastoral sort of role, rural role, playing a role in preventing the boom from exploding a lot earlier than it did.
Okay, the next question is from Giacomo Rella. Thank you for the presentation. Is there a systematic role for frauds in the bubbles surveyed in booms and bust? There is some evidence that frauds in the mortgage markets were quite important before the great financial crisis in the US, more than previously thought. About crypto bubble, social media look plenty of potential scammers selling very dangerous products to inexpert users, investors.
Yeah, so fraud is something. So it's not for us a major driver of bubbles, but there's always fraud in financial markets. And of course, when you have more amateurs coming into the market, they're going to be more susceptible to fraudulent schemes. So you typically do find more fraudsters coming into the market and deceiving, novices. Certainly true within cryptocurrency markets today. It certainly was true with the global financial crisis, but for us, fraud's not the thing that's driving these. It's there for sure. It's there, but it's not the thing actually driving these bubbles in the first place.
Great. And then I think, Joe, you had a question.
Yes, I did. Thanks, John, for the really fascinating talk. I think the sort of fire schematic is an incredibly useful one. And the question I want to ask, but basically, is it possible, do you think, for something to be recognized as a bubble, sort of there to be general consensus that something is a bubble? And I'm talking now in sort of contemporary times, but with sort of generational cohorts and mass democracy and liberal Western democracies, do you think that we can see a scenario where something is generally seen to be a bubble, but letting it collapse would be so politically detrimental to whichever party is in government that, per your sort of triangular diagram, the government keeps throwing sort of, fuel upon the fire, so to speak? I'm thinking of house prices in particular, where I know in many Western countries there's a huge problem where the sort of generational splits, right?
Yeah, absolutely. So because so many bubbles are politically sparked, politicians have an incentive to keep them going, and they also have an incentive to mop up after. So if you think of the global financial crisis, we push down interest rates and we keep them at super low rates. That helps people who had borrowed to buy overpriced homes, and there's a political reason why you want to do that. But here's the thing: it's really hard in financial markets to prevent asset prices tumbling. Now, again, central banks can intervene and do all sorts of weird and wonderful things, but it's really hard to prevent it. And the prime example of that is China. So in China in 2015, the government, for a variety of reasons, had sparked a bubble and were engineering a bubble. And they went to, and again, we document this, they went to super lengths to prevent this bubble from popping. Now, if any government should be able to prevent a bubble from popping, it should be the Chinese government. But they were unable to, and they tried to manage the decline as best they could, but they nevertheless weren't able to stop it from imploding. And so, yes, governments have incentives to keep things going, but their ability to, particularly in financial markets, is limited. And when financial markets want to head south, they very quickly will do so. I think you're right about land and property prices. I think there's a whole political dynamic behind land and and property prices that that governments don't want to see prices drop too far, because there's a lot of voters out there, and those voters, if your property prices have been hit, or if you can't get on the property market, you get this sort of these sort of problems.
Thanks, John. If I might just jump in with a follow-up, actually.
Yeah.
China's super interesting, right? Because it's one for many reasons, of course, but as far as I understand, it has capital controls, quite serious capital controls. I wonder if you could take us through a little bit the sort of journey we've been on since the abolition of capital controls, and whether this has or hasn't played a role in any sense in terms of bubbles.
Yeah, so capital controls, really, this determines the amount of fuel that can be poured on a bubble. And so if you go back to the 1720s, money can move easily between Paris, Amsterdam, London, okay? And that provides more fuel. You get more speculators coming in. You look at bubbles like the Australian one that we talked about, and so you get, again, a lot of British money heading into Australia, so like 1/4 of bank deposits. China didn't have, is okay with capital controls, doesn't have all of this foreign money flooding into its system, but it does have a lot of citizens who, without a developed pension system, there's very few places their citizens can put their money. They either buy an apartment, put it into government-owned banks, or put it into the stock market. And so they're almost, and they can't export it out of the country. So they're forced into putting their money into the stock market. So capital controls, all the capital controls do, the removal, is increase the amount of fuel that's there. So we saw that with the global financial crisis. We saw it to a certain extent with Japan in the 80s and 90s. But it just increases the amount of fuel. So you get a larger bubble, in essence.
We have 5 minutes more if anyone else wants to write another question. Otherwise, I have a quick one. So I was just thinking that, so you mentioned that sometimes bubbles can be beneficial, right? And that one of the sparks to a bubble can be a new and sort of radically new technology, basically, which there's loads of examples of, I'm sure. But I'm wondering almost whether, could one argue that a bubble is almost a necessary part of the introduction of a new technology? I mean, like, it's not just that it's useful, it's actually necessary in order to spread this new technology around rapidly. And then, of course, everyone is going to get on board on that, and there's going to be movement towards like some sort of perfect competition and no profit, and then companies are going to collapse. But that might be actually how you get the technology established in the first place.
So there are scholars who do argue this. So people like Bill Janeway and Carlota Perez, who basically say you actually need a bubble to create this sort of, particularly these sort of big network type so the railways, for example, in the UK. So the first major rail network, you kind of needed the bubble, as their argument, to create this. But nevertheless, you do get major new technologies emerging without bubbles. Okay, and the bubbles only emerge when you've got the other three sides of the triangle. So when interest rates are lower, there's lots of credit, or the marketability is there. So we've had technology emerge recently, and there hasn't been a bubble per se, because a lot of it has not been marketable. It's been venture capitalists who funded it. We've had, steam engine, for example. We didn't have, there's a major technology that really transformed. We didn't have a bubble around, steam and steam engine. And so there have been new technologies developed, electrification, chemical industry, oil, and wasn't necessarily associated with bubble. And that's because some of the other sides of the bubble triangle weren't present.
Yeah, but are there any examples of a bubble forming for a product which is a general purpose technology? I mean, the ones you mentioned are all general purpose technologies, right? So like, because I'm thinking maybe that's a different type of product altogether. Whereas I sort of think, because there must be some psychology involved in this, right? So, you come up with a bicycle and everyone says, oh yeah, that's obviously has some potential. I want to get into that, right? And
yeah.
Whereas electricity, it's like not everyone can get into electricity.
Yeah. So they don't necessarily see it. But yeah, it's interesting that not every major new technology is associated with a bubble, but that there are these major technologies. So I think the internet revolution, railways to some extent. Though the railway story, actually, it's not actually a technology story that we tell in the book. It's a political story. It's the way in which the British Parliament actually went around authorizing new railways. Other countries didn't have a railway mania anywhere near to the same extent the UK did. It was the way the UK, it was their belief in sort of laissez-faire, the belief in competition that really, you know, the politicians messed up on that one rather than the technology per se.
Anyway, we have one more question that's just dropped into the question and answer thing from Simone Vega. Do you see gold rushes of earlier centuries, 1849 in California, 1850s in Australia, etc., as a kind of bubble? That's a good question.
Yeah, no, because so I can see where the question's coming from in the sense of you know, the psychology, the you know, sort of the speculator psychology, but we're not associating these sort of gold rushes with, you know, huge increases in prices, with you know, huge collapse in prices. It's interesting. So on the Australia one, for example, there is this sort of story that was told that particularly in the British press in the 1890s, that the Australians are all gamblers, and the argument went like this: you basically had all of these people that headed to Australia, you know, as prospectors, as you know, gold speculators, and then once they had done that, then it was ingrained into the population to be speculative, to take more risk, and so it potentially does feed into then attitudes towards risk taking and attitudes towards speculation. So indirectly, you can see that link through then into later sort of periods.
Great, we're out of time, John. Thanks so much. That was really a great talk. I really enjoyed it. I'll have to read the book or listen to the audiobook. Thanks so much.
Thanks very much, everyone.